So I had a question the other day from a friend who I thought knew more about trading and investing and the difference than the question he asked led me to believe he knew about the difference, which surprised me. So I'm going to go through it in this video in a bit more detail. Welcome back to the channel, guys. If you're new to the channel, make sure that you head down and subscribe to the channel so you get all the future content coming out, all videos stock market related, whether they're educational, what I'm buying into, or just news and information about stocks in the stock market. Make sure you subscribe for all future content, and while you're down there, make sure you give the video a like, or wait until the end of the video you've liked the content and then give it a like because you've liked it. Pop a comment down below as well, whether you're more into trading or investing. There's a difference, I guess. There are overlaps in both, but they have, I would consider them to be different things. I would consider myself more an investor than a trader. But as I said, there are overlaps in the two, and I guess they do both kind of allude to the same thing in a way. But we're gonna go through it in a bit more detail. And then we'll have a quick look at the accounts that you could open for both scenarios, whether you want to invest or whether you wanted to trade, because they're typically done on two different types of brokerage. So we're going to go through the first one. We're going to go through investing first. That's what I'm more involved in, and I'll give you the characteristics of an investor, I guess, and what they look for, and for me and from my point of view, what investing is all about. So the first thing to know is time frame. Investing typically is done over a longer period of time, and I'll keep saying typically because, again, there's no one hard fast rule, but typically investing is done over a longer time frame, and we're probably talking years and years and years until something encourages us to change what we want to invest in, i.e. if a company we invest in changes something years down the line, then we're more likely to pull our money out. So investing is a case of actually investing into a company or into an asset or into a commodity without really the immediate future plan to sell out of it in any way, shape or form, because you're buying into something that you truly believe in, which leads me on to my next point. So investing is more buying into a company, you're buying a portion of a company, or you're buying physical assets or commodities, or whatever it might be. You would invest into but listening to companies for the moment on the stock market, you'd invest into a company because you genuinely want to own a part of the company. So big time investors in Apple, let's say, certainly the early investors, they loved what Apple was doing. They wanted to be a part of the company. They wanted to own a part of the company. They will still hold that company even now, I would have thought, unless they want to physically realize their profits and actually use the money earned from it. That's obviously one of the overlaps, is to earn money, but they would have wanted to be part of the company. Same way as you'd want to own physical gold, Bitcoin now, maybe commodities, property, you physically want to own it. And the third thing is typically the type of account that somebody would use to invest in is a non-leveraged account, far less risky. You're not going to get your margin calls and blow an account normally. So what people would generally do is open a stocks and shares ISA or a normal investment account, put the money in, it's non-leveraged. Whatever you're putting into the account is then invested into the company, no more, no less. It's far less risky. You don't have leverage on the account. So if it does go south by 10, 20, 50, 92% in the case of Luck and Coffee, still need to do a video on that, then you only lost that amount and you still have equity within that company that is realizable. You could sell that and take that away. On a leveraged account, if a position was to go down by that much and you didn't have a stop loss, typically you'd just blow the account because you'd be margin called, which we'll go to in a second. So that's the main thing about investing. It's less risky. You'd have a specific account for it. It would be non-leveraged, and you're investing into something because you honestly want to be part of the company. And there's all types of different investors as well, which I won't go into in this video. We've got value investors, income investors, probably high risk speculative investors like the penny stocks, which is probably, small interruption, pizza delivery. So let's go on to trading. So trading will typically be on a shorter time frame, not always. I know some people that will hold a position in a trading account, trading currency and things like that for up to a year or even longer. If you've got maybe, I don't know what they'd be called, maybe position traders. My brother is exactly that. He's a long-term trader, and he'll get into a position for a number of months or even up to a year if he's still going in the right direction. But typically the time frames are going to be much shorter. You get day traders that can be in and out of a position in literally a day, hours, minutes. Scalp traders will literally get into a position and out of a position in a matter of minutes and just take real quick profit. So they're in and out of positions much more frequently, generally, and much quicker. Second thing to say about traders is the fact that they're not necessarily looking to buy into a company because they believe in the company. They'll be looking to buy into a stock, a currency, a commodity, or whatever it might be, because price action and the trends, the price trends are steering them towards a certain way, and it's purely a profit-making machine. They don't necessarily believe in the company or believe in the commodity. It's just a case of it's around this level due to its history and how it's behaved before and its price action and how it's behaving now and hitting certain levels of support or resistance and following a trend line, bouncing off a trend line. I believe that it's going to, and then based on that particular candle, I think it should be price target up here. I don't necessarily believe it. I may not even know the financials of the company, the balance sheet, last year's earnings. I might not know anything about that. I might just look at it as sentiment in the market and the fact that I think it's going to push higher because it's going to bounce off this, and then I'm going to set a price target at this or whatever it might be. So typically it's not necessarily something you would believe in. It would just be, I feel like I can make some profit here because it's setting up nicely price action wise. So the third thing is going to be the type of account that they would open. It'll be a leveraged account, which will be a spread betting account or a CFD or CDF account. I can never remember the acronym, which way around it is, which will be a leveraged account, which means the broker will lend the individual more money. It'll be a 1 to 20 leverage or 1 to 50 leverage, or whatever you might choose. So however much you're putting into the account, the broker will lend you X amount more to trade on their behalf, which means that your profit and the upside could be far greater than what you could put in. If you're only going to earn a couple of % profit on the £1,000 you put in, that's not a lot. But if the broker ups that and lends you 20,000 on a 120 leverage, and you're going to earn 1 or 2% on the far greater amount, that's going to yield better results for you. However, the downside of this is if it goes south and you don't set a stop loss, or it gaps your stop loss, i.e. the next day the price opens far lower and it completely jumps over your stop loss, then the downside is also far greater. Now this is a bad thing. Obviously that's a bad thing, and that's where you get into serious trouble, and that's how people can literally blow their accounts, because as soon as you get past that and you don't have enough margin left, money, equity in the account to cover the losses of the leveraged money, game over. Broker pulls the plug, and in some cases, if it goes far lower, I've seen cases where you then owe the brokerage. You don't want that. Far riskier. That's why it's so important when you're trading that you're putting on stop losses and things like that. So far riskier. For my experience, I have traded currency and I've invested. You need nerves of steel to trade. You need to know what you're doing. You need a game plan. You need to set stop losses, price targets. You need to spend, I spent a year and a half back testing strategies and algorithms. I was more of a indicator heavy trader in the currency market, and it didn't yield the results I wanted. I was probably one of those statistics to say that 75% of retail traders lose money, and I did. I probably didn't stick with it long enough. I think, in fact, I was closed off a few positions to take the money out, and in the demo account I was also mirroring that one. I forgot to close the positions and they went absolutely flying. So if I held in for a bit longer, yes, it could have worked out, but I was certainly steering more towards investing at that moment in time. So you need nerves of steel. You can't just jump straight into it and think you can do it. You need to be learning from people that know what they're doing, not scams, training in it, back testing, demo trading for a number of years to forward test your strategy, whatever it might be. You need to dial in a strategy and stick with it if it works. But let me give you an analogy. If you want to become a doctor and earn a living from becoming a doctor, or becoming a gas engineer and you want to earn a living from that, you have to train in it for 2, 3, 5 years, 7 years. I don't know what the amount, how long you need to train to be a doctor and things like that, lawyers, whatever else. Same goes for trading. You can't just jump straight into it and think you're going to know what you're doing and earn loads of money. It takes a long time to build up capital. It takes a long time to learn how to do it. I'm not saying investing, it doesn't take a long time to learn what you're doing in terms of reading balance sheets and reading financials and working out good companies at good values. And even though I'm not the best at it by a long shot, or even know a great deal about it, I'm still always learning. But it's far less risky, it's far less stressful, and if you invest in the right companies, i.e. dividend investing, which is a form of investing, that's what I'm more into, you do more often than not get return on your capital. Even if the stock goes down, you'll still get return on your capital of, your 3 to 5% or higher, depending on what you get into. So they're the main differences. Hopefully that kind of made sense roughly. I'll have a quick look at the brokerage accounts that you might want to be opening, and I'll do it on Trading 212, so that's easier, and then we'll wrap the video up. So just quickly then, so this is Trading 212. So I'm going to show you 3 accounts. If you just go to their homepage, we've got Trading 212 Invest. I have an account here, no commissions, no fees, no limits. Put your money to work and start growing wealth through investing. So it's literally just investing. It's a non-leveraged account. We've also got the ISA, which is the same sort of thing. It's a stocks and shares ISA, non-leveraged, no fees, no this, that, and the other, bloody, bloody, blah, but non-leveraged, and that has an ISA allowance, which in the UK is £20,000 a year, I think. So you can't put any more than £20,000 a year in there, but it's tax free. And then this one we've got active trading with leverage. It's a CFD account. So this basically means that it is leveraged. There is high risk. In fact, if we go into that, it may give us a bit more details. We can trade stocks, forex, foreign currency, indexes, and more, including commodities and things like that. We go down a bit further. Forex, stocks, commodities, and indexes like the FTSE and the S&P 500. And one thing I didn't mention out there with trading is actually you can short sell positions, which means that you're actually betting against the company. So whereas I said it's not necessarily you believe in the company to succeed, and that's why you'd invest in it so it grows and you make more money. With a leveraged account, you can actually bet against the company by short selling, and that's another. You can't do that in an investment account, but again, you can do in a CFD account or a spread betting account, simply because you're not necessarily investing into the company. It's glorified betting essentially. Got a disclaimer up here: CFDs are complex instruments and come with high risk of losing money rapidly due to leverage. 67% of retail investor accounts lose money when trading CFDs with this provider. They have to put that disclaimer out there just to say that your money is at risk. So they're the main ones. So we've got the invest account, safe, ISA, safe and tax free, but can't open it or can't invest it if you have another ISA, i.e. a bank ISA and things like that. And the CFD, as well as the CFD accounts, you've also got spread betting accounts, which is also leveraged. So that's it, guys. Hopefully that was helpful. That might have helped some people. That would be incredibly boring to many other people. So this is just more educational type video, getting that out there, hoping you learn the difference. Do your own homework on all of these different accounts, what you want to get into. Be very wary whether you're investing or particularly trading. But even if you're investing, be very wary. You will lose capital. You can lose capital. So it's certainly not for the faint-hearted. If you don't like any of that, stick it in a bank account. You'll lose money in the long run due to inflation. But if you don't like the risk of it, stick it in a bank account. It's definitely not the way to go in my eyes, but if you haven't got the tolerance for it, then stick it in a bank account. But investing's far less risky. Trading is far risky and takes a lot more effort and training to do in my eyes and from my experience. So just wanted to get that out there to explain the difference, and hopefully it's been helpful to some of you. So I'll wrap the video up there. I'll catch you guys in the next video. See you later.